Today we're going to be covering group insurance. Group insurance is a contract between the insurer and a body representing the group of individuals. This type of insurance originated in the US in the 1920s. Initially, it covered employees of specific group, of specific employers and so on, but gradually it spread to cover associations of professionals such as lawyers, doctors, accountants, and so on. Nowadays, the position is that the number of persons which are covered by such contracts is greater than those covered under individual contracts. One advantage of group insurance policies is, of course, the cost. Because of economies of scale, it is possible to offer premiums at a much lower level than if the individual had gone and purchased a personal policy. The effect of that is that a segment of society which would normally not receive insurance or normally would not be covered can afford to be covered. It is therefore an economical way of covering or providing benefits in respect of death or disability or retirement. As far as the policy is concerned, it's written in the form of a master policy, which is a contract between the insurer and the body representing the group of individuals, and any terms and conditions which are discussed and agreed on is between these two, i.e. the insurer and the body representing. The member does not have a direct contact with the insurer. The size of the group obviously varies from contract to contract, circumstances, etc. But it's usually in the range of 25 to 100 to start off. The amount of cover provided under these is based on a formula or based on is related to particular parameters. For example, the parameter may be the age, so the contract may say that anyone, an employee falling between the ages of 30 and 40 will receive 50,000 rupees sum assured, while between 50 and 60 will receive 60,000, and so on. So it's a factor, it's a function of the age and under those circumstances. Another parameter could be the salary. So the plan could say the benefit, the sum assured, is going to be twice the salary, 3 times the salary of the employee, and so on. Now, what are the characteristics of group insurance policies? You can see that as the group dynamics change, as the composition of the group changes, for example, in 1 year there could be 50 members of the group, next year it could be 100 because more people have joined the employer. So the total premium therefore would change, and obviously the total cover would change if it's, let's say, it's a function of salary, and as salary increases every year, or the salary package, overall salary package increases every year. Now, the thing to bear in mind about group insurance is that in assessing the risk, the insurer looks at the group as a whole and not as individuals. So the specific personal habits, circumstances of an individual may not be that important as far as the group scheme is concerned. When if we take the case of an employer group scheme, then we have the requirement that all the individuals who join the scheme must join the scheme. All the new employees must join the scheme regardless, and so that we don't have any anti-selection. Let me explain that a bit further. Where we have, say, 50 employees of a particular employer, then there is mix of young and old, mix of male and female, mix of those who are in very good health, those who are not in so good health. As long as they all join the scheme, then the risk of a claim, if you like, from the insurer's point of view is evened out, and he can then offer better terms. Whereas if only employees who are in good health decide to join, or only employees who are above a certain age join, then that might not work from a group premium point of view, from a group liability point of view. As far as eligibility for entering the group plan is concerned, one must bear in mind that the groups must not be formed specifically to get the insurance covered. There must be some other reason why the group was there. It must exist without the need for saying that we're only setting this up because we want some insurance. Another thing is that another point is that the group must not be a closed group to be able to get the best out of such contracts. If, for example, for an employer's group, you have people, employees coming, joining, and then leaving through retirement or whatever, so it's a moving group. If it was a closed group, in other words, no new employees were allowed to join, then eventually the group would die out. Because of the spread of the risks within the group, the health reasons, the health risks are of course considered a part of underwriting, but they are not as important as if the individuals were to go on their own to the insurance company. So what sort of groups, what are the eligible groups for a group insurance? We will have, as mentioned already, employer groups. You can have multiple employer groups. In other words, if there are subsidiaries of the same employer, then they could all club together, they could all join together, and the employees could all be members of the same group scheme. Of course, that has the advantage of being able to share out the expenses within the different companies, and the cost again goes down. You can have the workers' union groups, the creditor-debtor groups, and of course there are other miscellaneous groups as well. So let's look at the individual employer group a bit more. Under such schemes, so this is where the employer has set up the group schemes for an insurance company, involved in the screening of the employee as normal part of taking him on. There could actually be a medical requirement, a medical examination requirement before the employee joins the employment. So that's helping the insurer, if you like, in determining the risk level under that for that employee. The employer would also make a note of all the, or record all the employee data, including date of birth, and authenticating the date of birth through birth certificate. So that work is being done on behalf of the insurer, if you like. The premiums could be collected if it was a contributory scheme. Then the employer would collect all the premiums from the employees and then make one single payment to the insurer. And also, in the event of a claim, for example, the first point contact point would be the employer, and then that could be passed on to the insurer. We've already mentioned the multiple employer groups. In other words, say the employers which are related, connected with each other because they are subsidiaries, or they could be associated employers. Then they can form groups themselves to start a group scheme, thereby reducing the costs. And the workers' union groups, where the policy covers the union members and the policy itself is issued to the union. The union is responsible for paying the premium, which could be out of the union funds, or it could be from premiums collected on behalf of the members. Next, we consider the creditor-debtor group schemes, where the benefit could be used as collateral for the loan. In the event of death, if there is still a loan outstanding, then that could be the sum assured. The benefit could be used to pay off the loan. If any money outstanding, if there is any money remaining, that will be passed on to the legal heirs. Again, the cover and cost, the premium cost would be lower because of the group sizes involved. Mentioned the miscellaneous groups. The miscellaneous groups could cover the professional associations of teachers, lawyers, doctors, etc. Now, certain banks have actually set up or are offering group schemes for the deposit holders. So there's another way of forming a group. So we've now looked at groups, various types of groups, and let's consider the different group insurance plans as they're available. First one, of course, one should mention is the group life insurance plan, which we've heard about, and under that, the employee deposit linked insurance plan, which is a type of group life insurance plan. Then another broad category is the group health insurance plan, and under that we have the managed care plans, and yet another group is the group of policies is the group disability income plan. And related to that, you can think of the workers' compensation plan. Under that type of plan, of course, compensation is required in respect of injuries at work. So, in other words, a disability caused by injuries at work. So, let's look at the group life insurance plan in a bit more detail. It, of course, provides protection for a group of people at a low cost. There are benefits to the employer and benefits to the employee for setting such plans up. The benefits to the employer include the fact that it can serve as a strong retention tool. By that I mean that when an employee sees that the employer is offering him a scheme which will provide him with financial security, and that plan may be free, so the employee may not be required to contribute towards it. And then there is, as far as the scheme insurance cover is concerned, the insurance company is able to offer free cover limits, and what that means is that up to a certain level, no underwriting is required. So the scheme might say up to 50,000 rupees of cover will be provided without any underwriting requirement, which makes the administration simpler from the point of view of the employer, and of course from the point of view of the employee, the point of the insurer as well. Now, the benefits for the employee, as I said, it could be that the employer is able to offer this scheme free of cost. In other words, it's a non-contributory scheme. There's a hassle-free enrollment because the application form is very simple form. The amount of benefit payable, amount of the death benefit payable is tax-free, and of course, even if it is a contributory scheme, the cost of the scheme, the cost of the benefit is much lower to the employee than it would be if he goes outside the scheme and tries to get the same cover on his own. The employee's deposit-linked insurance scheme is one which we have covered before, and it's, as mentioned earlier, it is a death benefit scheme. In other words, it provides a benefit in the event of the death of the member before reaching his retirement age. Of course, as you can see, it's nothing but a group life insurance scheme. Under the scheme, it's a requirement that the value of the fund built up, value of the fund under the provident fund scheme built up for the member is paid out subject to a maximum level or maximum amount of 60,000 rupees. The employer, of course, can either go to the statutory scheme or he can set up a private insurance scheme to provide this benefit. LIC, for example, offers a plan in respect of this cover, which has advantages for the employer and the employee. From the employer's point of view, the advantage is that the premium payable is usually lower than the contribution that you would have to make under the statutory scheme. Another advantage is that the claim is dealt with fairly quickly. Only thing that's required is a claim form and a death certificate form. From the employee's point of view, the advantage is that the calculation of the benefit is much simpler. It's not related to the valuation of the fund under in his account, which has to take into account salary over the last, the value of the fund over the last 12 months, etc. It's a straightforward formula of how long he has been with the employer and the salary and his current salary. So, in this topic, under this topic, we covered what is a group insurance, we covered the characteristics of group insurance, we covered the different eligible groups, the different types of group insurance available, and in particular the group life insurance, and next we will be covering the other types of insurance, group insurance, such as health insurance and disability insurance. So I'll stop here for the time being. Thank you.